Two trades today, two completely different outcomes. One was a clean setup that the market just didn't respect. The other was the kind of trade that reminds you why you stick to the process. Let's get into it. First things first, every morning I mark the 4-hour range. That's the high and the low of the very first 4-hour candle that formed that day, based on the New York time, of course. Those two levels become my entire game plan for that day. No indicators cluttering the chart, no guessing, just the range. So my first trade was on gold. I'm watching the 5-minute chart. So as we can see, price starts pushing down toward the range low and breaks below it. And here's the key. The candle actually closes below, not just a wick, a full close. The wicks don't count, of course. Then the next candle closes back inside the range. That's the sequence. Breakout, come back in. That's my long signal. The range low just acted as a trap. Price dipped under, grabbed liquidity from the people who were holding shorts, and then came back inside. It's a classic move, but before I touch the buy button, I check the MACD. In this case, it happens to be positive, so momentum is pointing up, which lines up perfectly with the long trade. Both the setup and the momentum are telling me the same thing. That's confluence, and confluence equal confidence. Entry goes on that candle close back inside the range. Stop loss is at the exact low of the breakout move, because if price goes back down there, the trade thesis is dead and I'm out. No arguments. My take profit always remains at 2R, twice the risk. That's the target every single time. So as you can see, price nudges up, starts to look like it's working, and then the market just said no. No fake out candle, no warning shot. It just rolled over and came back down through the range low. Broke the stop, and that was a $1,200 loss. Even though I followed all my rules, the market just didn't care. Now at this point during the day, I was about ready to quit because I had waited for that setup for about 60 minutes, but then I took a second trade. Same day, different market. Euro USD 4-hour range is marked, and I'm back on the 5-minute chart watching price move inside the range. Then it starts climbing, price pushes above the range high, and again the candle close outside, full body above the line. I've seen this before. Price breaks above the range high, which triggers all the retail buy orders that have been sitting above it. Breakout traders jumping in late, stop losses being hit on shorts. The market grabs all of that liquidity and then reverses. It's a stop hunt, and the candle closes back inside the range is the confirmation that the breakout failed. Next candle closes back inside. That's a short signal. Now I go to the MACD, which is negative. Momentum is already pointing down. The setup is saying short. The momentum is saying short. When everything is aligned like that, there's nothing to deliberate about. You take the trade. Entry on the close. Stop loss goes at the high of the breakout candle, the very top of that failed move, because if price goes back up there and crosses, the whole setup is invalid and I'm out. Take profit at 2R as always. Same process. Price drops immediately. No hesitation. No fake out. The kind of move where you set the trade and lean back because there's nothing left to do. It works its way down and cleanly hits the target. Now this was my biggest trade for the year and nearly $9,000 winner. That's what fully confirmed setups look like. So these two trades are a perfect illustration of something I want you to really sit with. The gold trade and the Euro USD trade were built the exact same way. The same strategy, same checklist as always, same logic. One lost nearly $1,200 and the other made nearly $9,000. And I executed them both correctly. Well, on my second trade, I'll admit, I risked a little bit more than I usually risk. I usually risk about 5 to 10% of my account, and this time I risked about 20%, which is not my usual risk tolerance. But the part that most beginners struggle to accept is they think that if a trade loses, something went wrong. But a loss doesn't mean that the setup was bad. It means the market moved against a valid position, and that is always on the table, no matter how good you read the market. That's why you say a strategy has an 87% win rate. It wins 87% of the time and loses the rest of the time. What matters is that you keep your winners bigger than your losses, and you stay consistent enough for that edge to play out over time. That's why I always set my target at 2R. In this way, I'm always ensuring that my winners are bigger than my losers, and I never play with it. I never move it around. It's always stuck at 2R. After the gold loss, I didn't change anything. I didn't go looking for a revenge trade. I moved to our next market and applied the same rules and let the process do what it does. The only thing I would say I did differently was take a little bit more risk, but I followed the strategy as always. By the way, if you want to start putting this into practice, I use Exness. It's a no-nonsense tight spread broker, and you don't need a big account to get started. $10 gets you in the door. The link will be at the top of the description and in the pinned comment. Always remember this: the trader who survives the losses without breaking is the one who eventually gets to keep the wins.